If you own crypto in the United States, the United Kingdom, or Canada, there is one question you absolutely cannot afford to ignore in 2026, and that question is this: how much tax do you owe on your crypto? Because here is the truth that most crypto investors do not want to hear: your government already knows about your crypto. In 2026, the OECD's Crypto Asset Reporting Framework, known as CRF, is being implemented globally, meaning crypto exchanges are required to share your transaction data directly with tax authorities automatically. The U.S. Treasury finalized the Digital Asset Broker Rule in 2025, mandating that all brokers and exchanges report every user transaction starting with 2025 trades. The UK's HMRC introduced real-time reporting for large crypto transfers above £10,000 in 2025. And Canada's CRA now requires mandatory reporting for crypto transactions over $50,000 Canadian dollars. In 2026, the rollout of Form 1099 DA in the US, DAC 8 regulations in the EU, and new exchange rules in the UK have expanded international reporting standards significantly. The days of hiding your crypto gains are officially over. In this video, I am going to give you the complete 2026 crypto tax guide for the USA, UK, and Canada. I will explain what is taxable, what rates you pay, what is tax-free, what forms you need to file, and most importantly, the legal strategies you can use to reduce your tax bill, whether you are a casual holder, an active trader, or a DeFi user. This guide covers everything you need to know. Let's get into it. Before we get into country-specific rules, let me explain the three most important concepts that apply to crypto taxes in all three countries, because understanding these fundamentals is the key to everything. Concept 1 is taxable events. A taxable event is any action with your crypto that triggers a tax liability. Many investors believe taxes only apply when they convert crypto into traditional money. But in 2026, the reality is much broader. In most countries, including the US, UK, and Canada, crypto is treated as property or something similar. This means you owe capital gains tax whenever you dispose of it, which includes selling for cash, swapping one coin for another, or spending it on a coffee. Your taxable profit is simply the difference between your buying price and the value when you moved it. The most common taxable events in all three countries are selling crypto for fiat currency, trading one crypto for another crypto, spending crypto on goods and services, receiving staking rewards and yield farming income, receiving airdrops and free tokens, and getting paid in crypto for work. Concept 2 is cost basis. Your cost basis is what you originally paid for your crypto. When you sell your crypto, your taxable gain is the selling price minus your cost basis. For example, if you bought Bitcoin at $30,000 on January 1st, 2023 and sold it at $77,000 on June 1st, 2024, your taxable gain is $47,000. Keeping accurate records of every purchase price is absolutely critical for calculating your tax correctly. Concept 3 is the difference between capital gains and income tax. Depending on how you acquired your crypto, it may be taxed as capital gains at a lower rate or as ordinary income at a higher rate. Generally, buying and selling crypto creates capital gains, while earning crypto through staking, mining, or work creates ordinary income. Understanding which category applies to each of your crypto activities is essential for minimizing your tax bill legally. Now let's talk about US crypto taxes in detail, because the IRS has one of the most comprehensive crypto tax frameworks in the world. The US treats crypto as property under IRS guidelines. This has been the case since 2014, and it remains the foundation of US crypto taxation in 2026. Here are the key rates and rules every US crypto investor needs to know. Short-term capital gains apply when you sell or trade crypto that you held for less than 1 year. Assets held for less than 1 year are taxed as ordinary income at rates from 10% to 37% depending on your total annual income. This is the same rate you pay on your salary, so frequent traders face potentially very high tax bills. Long-term capital gains apply when you hold crypto for more than 1 year before selling. Assets held for more than 1 year qualify for long-term capital gains rates of 0%, 15%, or 20%. Plus an additional 3.8% net investment income tax for high earners. This is one of the most powerful legal tax reduction strategies available to US investors. Simply holding your crypto for more than 1 year cuts your tax rate dramatically. The new Form 1099 DA is critical for 2026. US crypto exchanges are now required to issue Form 1099 DA to all users reporting their crypto transactions directly to the IRS. This means the IRS will already have information about your crypto transactions before you even file your return. You must report all crypto gains and losses on Form 8949 and Schedule D of your tax return. Crypto income from staking, mining, or freelance work is reported as ordinary income on your Form 1040. You must also answer the crypto question on page 1 of Form 1040. The penalty for intentional crypto tax evasion in the U.S. is up to $250,000 and potential prison time. You can use losses to offset gains, and if losses exceed gains you can deduct up to $3,000 against ordinary income per year. Now let's talk about UK crypto taxes, because the rules here are somewhat different from the US and many UK investors are still confused about what exactly they owe. In the UK your crypto is governed by HMRC, which stands for His Majesty's Revenue and Customs. The UK taxes cryptocurrencies at a capital gains and income tax level depending on the nature of your transactions. As a general rule, if you trade any cryptocurrency for another crypto, for fiat, a stable coin, or an NFT, you fall under a capital gains tax scenario. If you spend crypto to buy a product or gift it, you are taxed on the gains. However, if you earn income from products like staking, you are taxed according to your income tax rate. Here are the key UK rates and rules for 2026. The annual exempt amount for capital gains is £3,000 in 2026. This means you can make up to £3,000 in crypto profits each tax year completely tax-free. Capital gains tax rates for crypto in the UK are 18% for basic rate taxpayers and 24% for higher and additional rate taxpayers as of 2026. Income tax on crypto earnings such as staking rewards and airdrops is taxed at your personal income tax rate, which can be up to 45% for the highest earners. The UK tax year runs from April 6 to April 5. So your 2025 to 2026 tax return covers all transactions from April 6, 2025 to April 5, 2026. HMRC introduced real-time reporting for large crypto transfers above £10,000 in 2025. The penalty for crypto tax evasion in the UK is 100% of the unpaid tax plus interest and prosecution risk. Losses can be used to reduce capital gains, potentially bringing your total profit below the tax-free annual allowance of £3,000. This loss harvesting strategy is one of the most powerful legal tax reduction tools available to UK crypto investors. Now let's talk about Canadian crypto taxes, because Canada has made some very significant and important changes in 2026 that every Canadian crypto investor needs to know about immediately. In Canada your crypto is governed by the Canada Revenue Agency, or CRA. In 2026 the Canada Revenue Agency classifies cryptocurrency as a commodity, not currency. This classification means your crypto is subject to either capital gains tax or business income tax depending on your trading behavior and intent. Here are the critical 2026 Canada-specific rules. The new inclusion rate change is the most important update for Canadian investors. For tax returns filed in 2026 covering the 2025 tax year, the inclusion rate remains at 50%. However, for capital gains realized on or after January 1, 2026, the inclusion rate increases to 66.67% on amounts exceeding $250,000 Canadian dollars in a single year. The first $250,000 Canadian dollars of gains remains at the 50% inclusion rate. This means if you made more than $250,000 Canadian dollars in crypto gains in 2026, the portion above that threshold is now taxed at a significantly higher rate. For example, on a $20,000 capital gain in Canada at the 50% inclusion rate, $10,000 is added to your taxable income and taxed at your marginal rate. Capital gains versus business income is a critical distinction in Canada. If you are a casual investor buying and holding crypto, the CRA treats your gains as capital gains. However, if you are day trading frequently with the intent to profit, the CRA may classify your entire activity as business income and you pay tax on 100% of your profits instead of just 50 to 66.67%. The implementation of the Crypto Asset Reporting Framework (CRF) has been delayed to January 1, 2027 in Canada. While mandatory reporting is not yet active in 2026, Canadian exchanges are already preparing their systems for future compliance. The personal tax return deadline in Canada is April 30, 2026, and late filing results in penalties and increased audit risk. Foreign property holdings over $100,000 Canadian dollars must be reported on Form T1135. Now let's talk about DeFi staking, airdrops and other crypto activities that confuse a lot of investors when it comes to taxes, because these are increasingly important in 2026 and the rules are clear but often misunderstood. Staking rewards in all three countries are taxed as ordinary income at the time you receive them based on their fair market value at that moment. In the US, staking rewards are reported as other income at your personal income tax rate. In the UK, staking income is taxed at your personal income tax rate, which can reach up to 45% for the highest earners. In Canada, staking rewards are generally treated as business income or capital income depending on your level of activity and intent. DeFi yield farming in the US and UK requires you to report every yield payment as taxable income at the time of receipt based on fair market value. Every time you receive a yield payment, it creates a new taxable income event. The gas fees you pay on DeFi transactions can sometimes be added to your cost basis, which reduces your eventual capital gains when you sell. Airdrops and free tokens are treated as taxable income in all three countries at the fair market value of the tokens at the time you receive them. This catches many investors completely off guard because they did not choose to receive the airdrop, but they still owe income tax on it. Crypto-to-crypto swaps are taxable events in all three countries. When you swap Bitcoin for Ethereum, you have technically disposed of your Bitcoin and must calculate and report any capital gain or loss based on the difference between your cost basis and the fair market value of the Bitcoin at the time of the swap. This is one of the most commonly misunderstood rules in crypto taxation worldwide. Mining income in the US, Canada and UK is treated as ordinary income at the time of receipt based on fair market value and then subject to additional capital gains tax when eventually sold. In 2026, tax authorities are using the OECD CARF framework to automatically track all of these DeFi and on-chain activities across borders. Now let's talk about the most powerful legal strategies you can use to reduce your crypto tax bill in 2026, because paying more tax than you legally have to is simply not good investing. Strategy 1 is the hold for 1 year strategy in the US. This is the single most impactful strategy for US investors. By simply holding your crypto for more than 1 year before selling, you qualify for long-term capital gains rates of 0%, 15%, or 20% instead of short-term ordinary income rates of 10% to 37%. On a $50,000 gain, this difference alone could save you between $5,000 and $8,500 in tax. Strategy 2 is tax loss harvesting in all three countries. In the US, you can use losses to offset gains, and if losses exceed gains, you can deduct up to $3,000 against ordinary income per year. In the UK, losses can be used to reduce capital gains, potentially bringing your total profit below the £3,000 annual tax-free allowance. The strategy is to sell your underwater crypto positions to realize the loss, which offsets your profitable gains. Strategy 3 is using the UK annual exempt amount of £3,000 strategically. Every UK taxpayer gets £3,000 of capital gains completely tax-free each year. This resets every April 5th. Strategic investors who have moderate gains can time their sales to stay under this threshold each tax year. Strategy 4 is gifting crypto to a spouse or civil partner in the UK and Canada. In both countries, transferring crypto to a spouse or civil partner is generally not a taxable event and can effectively double your annual tax-free allowance. Strategy 5 is maintaining meticulous records of every single transaction, the date of purchase, the amount paid in your local currency, the date of sale, and the proceeds. This is the foundation of accurate tax reporting and is required in all three countries. Strategy 6 is using crypto tax software to automate all of your record keeping and tax calculations, which we will cover in detail in the next section. Now let's talk about the tools and software that make crypto tax reporting manageable, because manually tracking hundreds or thousands of transactions is nearly impossible for most investors. Crypto tax software automatically imports your transaction history from exchanges and wallets, calculates your gains and losses, generates the correct tax forms, and helps you identify tax optimization opportunities. The most widely used platforms in 2026 are as follows. Koinly supports all three countries, US, UK, and Canada, and is considered one of the most user-friendly options for everyday investors. It integrates with over 800 exchanges and wallets and generates country-specific tax reports. Koinly starts from $49 per year. TaxBid is particularly strong for US investors and has been used by major exchanges to generate Form 1099-DA reports. TaxBit supports 500+ exchanges and platforms and also starts from $49 per year. CoinTracker supports all three countries and is known for its clean interface, comprehensive DeFi support, TurboTax and TaxAct integration, and live customer support. CoinTracker integrates with over 10,000 platforms and starts from $59 per year. CoinLedger, formerly known as CryptoTrader Tax, is popular with U.S. investors for its direct integration with TurboTax and H&R Block. It supports 500+ exchanges and wallets, includes tax loss harvesting tools and IRS audit summaries, and starts from $49 per year. The cost of crypto tax software is typically tax-deductible as an investment expense in the US and UK. One important warning: while tax software is extremely helpful, it is not a substitute for professional advice, especially if you have complex DeFi activity, large gains above $250,000 in Canada, business income from trading, or cross-border crypto activities. In those cases, consulting a qualified crypto specialist tax accountant is strongly recommended. So let's bring this all together with the most important points from this complete 2026 crypto tax guide for the USA, UK, and Canada. In all three countries, crypto is treated as property or a commodity, meaning every disposal is a taxable event. This includes selling for cash, swapping one crypto for another, spending crypto, and receiving staking or mining rewards. In the United States, short-term gains under 1 year are taxed at 10 to 37%, while long-term gains over 1 year are taxed at 0 to 20% plus 3.8% NIIT for high earners. Form 1099-DA is now required from exchanges, and all gains must be reported on Form 8949 and Schedule D. In the United Kingdom, capital gains are taxed at 18% for basic rate taxpayers and 24% for higher rate taxpayers. You get £3,000 completely tax-free each year, and staking income is taxed at your personal income rate of up to 45%. The UK tax year runs April 6 to April 5. In Canada, capital gains are taxed at a 50% inclusion rate for the first $250,000 Canadian dollars and 66.67% for gains above that threshold from January 1, 2026. Day traders may face 100% business income taxation. Tax returns are due April 30, 2026. The most important tax reduction strategies are holding for over 1 year in the US to get the long-term rate, tax loss harvesting in all three countries, using the annual £3,000 allowance strategically in the UK, and keeping meticulous records everywhere. The consequences of not paying your crypto taxes are severe. In the US, penalties reach up to $250,000 plus possible prison time. In the UK, you pay 100% of the unpaid tax plus interest and prosecution risk. In Canada, you face fines up to 50% of unpaid taxes and possible criminal charges. The message is absolutely clear in 2026, crypto taxes are real. The authorities are tracking your transactions through CRF and Form 1099-DA, and the right approach is to understand the rules, use legal strategies to reduce your bill, and file accurately every year. Always consult a qualified tax professional for your specific situation. If this video helped you understand crypto taxes, please hit the like button and subscribe to the Crypto Skill for more videos like this. Drop a comment below. Which country are you in, and did this video help you understand your crypto tax obligations?